Imagine knowing the exact direction a stock is going to move. Like being 100% right about the fundamental business catalyst.
Right.
And you still wake up to find you've lost, 95% of your money overnight.
Yeah, it's brutal.
It is entirely brutal.
Yeah.
And that is the totally nonlinear reality of holding derivatives through a major corporate earnings report.
It really is.
Because usually when we look at financial investments, we expect some level of linear arithmetic. You buy a fractional share of a company, the market cap expands by 2%, and, well, your equity expands by 2%.
Exactly. It's proportional.
Right. It's proportional.
Yeah.
But you step into the options market, particularly around a binary event like earnings, and that linear reality it shatters. It breaks into a million pieces of complex probability math.
It absolutely shatters. And the reason it shatters is because the options market isn't actually pricing the stock itself.
Okay, what is it pricing then?
It's pricing the velocity of human panic, essentially. The cost of structural leverage and the probability of extreme multi-standard deviation events.
Wow.
Yeah, you are no longer trading the company. You are literally trading the architecture of risk itself.
And you, our listener, recently found yourself trapped right in the middle of that exact architecture.
Yeah, right in the crosshairs.
So we are going to spend this entire deep dive executing a complete forensic analysis of the source material you shared with us.
Because it's a fascinating setup.
It really is. We are looking at a very specific and, frankly, a very painful trade you held on the tech giant AVGO Broadcom right before their earnings report.
Yep.
You were holding a deep-in-the-money call spread. The stock was sitting at $480.
Right, at 480.
And you had this nagging thought right before the closing bell, like, should I swap this out? Should I move my risk curve and, buy the at-the-money $480 call spread instead?
But you held firm.
You held firm. You stayed in the deep-in-the-money position.
And then the report dropped.
Yeah. Post-earnings, the bottom just completely fell out. The stock crashed violently down to $423.
Just pierced right through it.
Right through the floor of your spread. And now, you're left staring at a massive drawdown, asking a very mathematically complex question.
Which is, did I make a structural mistake?
Exactly. If I had just bought that at the money option, would my portfolio have taken less absolute damage?
It's a phenomenal question. It really is, because it forces us to separate market psychology from mathematical reality.
Right.
The gut reaction to a massive drawdown is always regret. But regret is just a terrible metric for evaluating a trading system.
This really is. So our mission today is to completely deconstruct this exact Broadcom trade. We're going to unpack the brutal mechanics of implied volatility crush.
Yeah.
Not just that it happens, but exactly how the underlying pricing models actually forced it to happen.
We need to shift your perspective entirely here.
Yeah, we need to move you away from feeling like a reactive participant just staring at a red screen.
Right.
And get you thinking exactly like a Wall Street market maker who's analyzing a volatility surface.
Which means we really need to start by addressing that immediate what-if regret.
The big what if.
Yeah. What if you had just switched to those at-the-money calls right before the $57 drop? Let's look at the behavior of the Greeks on your actual position first.
Okay, let's break that down. You are holding the 430-550 call spread and the 450-550 call spread, and the stock is at 480.
Right. Let's focus on the behavior of that 430 strike price.
Yeah, right.
We know our listener understands the basics, right? They know that a 430 call with the stock at 480 has $50 of intrinsic value.
$50 of real hard value built right in.
Exactly. What we need to look at is how the Black-Scholes model treats that specific contract under the extreme stress of a $57 gap down.
Okay, so take us into the model.
Because it was $50 deep in the money, the delta of that option was sitting very close to 1.0, let's say 0.9.
Meaning it moves almost dollar for dollar with the stock.
Exactly. The pricing model viewed that option as having a near certain probability of expiring with intrinsic value. Therefore, it was acting as a highly efficient synthetic stock replacement.
It had immense structural integrity, like a sturdy house in a hurricane.
That's a great way to put it. And then the earnings report drops. Broadcom plummets from 480 all the way down to 423.
That's a 12% haircut on a mega cap tech stock in a single trading session. It's violent.
It's a massive move. But let's look at what the pricing algorithm actually did to your 430 strike.
Okay.
The stock is now at 423. Your 430 strike has lost its intrinsic value, yes. It went from being deeply in the money to being out of the money.
Right, because 423 is below 430.
But look at the proximity. You're only $7 away from the new stock price.
You are just outside the boundary, just slightly out of the money.
Right. And here is the critical mechanical factor. There were still 40-plus days to expiration on your contract.
No, the time value.
Yes. The pricing model looks at a highly volatile stock like Broadcom, looks at the 40 days left on the clock, and calculates that a $7 move, which is, less than 2%, is highly probable within that time frame.
So it doesn't just instantly reprice to zero.
No, the model refuses to drop the price of your option to zero. It retains a massive amount of its structural integrity in the form of time value and implied probability.
Okay, so the deep in the money option took severe damage, sure. But the structural foundation held because the time component anchored the probability curve.
Exactly.
Now, let's look at the alternate reality, the one that is causing all this regret for you. What would the Greeks have actually done if you had swapped to the $480 at the money call right before earnings?
Well, if you buy a 480 call when the stock is exactly at 480, you are buying an instrument that is composed of 100% pure premium.
Pure air. There is zero intrinsic anchor.
None. You are paying purely for the market maker's assessment of future implied volatility.
And before a binary event like an earnings call, that assessment is aggressively expensive, right? I mean, market makers are pricing in the maximum expected move.
Oh, it's extremely expensive. Now, let's hit that 480 at the money option with the exact same 12% gap down to 423.
Okay, what happens to it?
Two mechanical phenomena occur simultaneously in the pricing model to just absolutely annihilate that position. First, you experience gamma acceleration collects.
Wait, break down the actual curve of gamma for us here, because I think people view delta as a static number, but gamma is, it's the rate of change of that delta, right?
Yeah, gamma is the first derivative of delta, and the second derivative of the options price relative to the stock price.
Okay.
Graphically, the gamma of an option looks like a bell curve that peaks exactly at the money.
So right at 480.
Exactly. When you bought the 480 call at 480, you were sitting at the absolute peak of the gamma curve. Your delta was roughly 0.5, meaning it had a coin flip probability of expiring in the money.
50-50 shot.
Right. But the moment the stock gaps down $57 overnight, you slide violently down the left side of that bell curve.
So the delta doesn't just slowly tick down to 0.4, 0.3 like a slow bleed?
No, it accelerates downward. The gamma forces the delta to plummet from 0.5 to near zero almost instantly.
Wow. Instant flatline.
The pricing model looks at a stock at 423, looks at your strike way up at 480, and says, the probability of this stock recovering $57 in the remaining time is practically non-existent.
So the delta just zeroes out. The option essentially becomes untradeable.
Yep. And then there's the second phenomena.
Right, which is what?
Vega destruction, the infamous whole V crush.
Ah, Ivy crush. The widowmaker.
Implied volatility is not a measure of historical movement, you know. It is a forward-looking measurement of uncertainty.
Okay, forward-looking.
Before the earnings call, uncertainty is at maximum density. The market doesn't know the revenue, they don't know the forward guidance, or the AI chip backlog.
Everybody's just guessing.
Right. But the second the CEO finishes speaking on the earnings call, the uncertainty is resolved. The market knows the truth.
Even if it's a terrible truth that drops the stock 12%.
Exactly. It is now a known truth. The fear of the unknown is completely removed from the equation.
Okay, I see where this is going.
And because implied volatility is the primary input inflating the premium of that at-the-money option, when that volatility input drops from, say, 100% down to 40% overnight, the price of the option mathematically collapses.
Regardless of what the stock price itself is doing.
Completely regardless.
So, to put this in really stark terms for you, the listener, that 480 call, which was purely composed of expensive volatility premium, gets hit by a complete delta flatline A&D, a massive reduction in the Vega input simultaneously.
Yes. It would have been instantly rendered illiquid. The bid-ask spread would have widened drastically, and the actual mark-to-market value of that at-the-money option would have evaporated by 90 to 95% at the open bell.
Just an instant, unrecoverable wipeout, like pitching a tent right on the beach during a Category 5 hurricane.
Exactly. A total wipeout.
So the mathematical verdict on your regret is actually pretty clear. Holding the deep in the money spread was the correct calculated defensive posture.
It absolutely was.
The fact that an extreme multi-standard deviation move occurred and breached your strike does not mean the underlying structural choice was wrong. If you had taken the at-the-money position, your capital would simply cease to exist.
You built a position with a margin of safety. The margin was breached, yeah, but the architecture behaved exactly as it was supposed to under stress.
Okay, but hold on. This is where I have to push back on behalf of our listener.
All right, push back.
Because we're ignoring the actual cash flow here.
Yeah.
The math you just walked through is all percentage-based. But our listener is looking at their brokerage account balance in absolute dollars.
Oh, I see.
We have to look at the illusion of absolute cash loss, because this is where that gut-wrenching regret actually stems from.
It's a very powerful psychological trap for sure.
Right.
Let's pull the exact dollar amounts from the source materials to see why the intuition feels so right.
Let's do it. Before the crash, that deep-in-the-money 430 call was trading for around $58, right?
Right.
That means you have $5,800 of capital locked up in a single contract. But the at-the-money 480 call, that only cost roughly $25 or $2,500.
Correct. So the alternate reality the listener is obsessing over goes exactly like this. Right before the market closes for earnings, you sell your 430 call for $58, and you immediately buy the 480 call for $25. What is the net result of that transaction?
Though you pocket $33 in premium. You just extracted $3,300 in cold, hard cash out of the options market and put it right into your settlement account before the CEO even opens his mouth.
Exactly. And now, the morning after the crash happens, we already established that the at-the-money $25 option gets subjected to extreme vega destruction and gamma collapse.
Right, it gets vaporized.
It drops from $25 down to, let's be generous, $1.
Ouch.
So your absolute defined risk loss on that specific option is $24, or $2,400.
Okay, got it. Now let's track the capital on the actual trade you held. By sticking with the expensive 430 call, the value drops from $58 down to around $18.
Yep.
That is an absolute capital loss of $40 or $4,000 per contract.
The math is undeniable.
So wait, the listener's intuition is absolutely correct. By rolling up to the at-the-money option, they would have lost $24 instead of $40.
In absolute terms, yeah.
They would have literally saved $1,600. Why on earth wouldn't a rational trader execute that swap to minimize their absolute dollar risk?
Because you have to evaluate what structural asset you sacrificed to save that $16.
What do you mean?
You traded a highly reactive living financial instrument for a completely dead asset. You surrendered the entirety of your mathematical recovery mechanism.
Okay, explain that mechanism. What's the difference here? Live money versus dead money.
Let's dissect the $1 remaining in that at-the-money 480 call.
The dead money.
Right. The stock is currently trading at $423. For that option to regain any intrinsic value at all, the stock has to travel $57 just to reach the strike price.
Which is huge.
It requires an impossible 13.5% bounce in a mega-cap stock.
And it has to do it while fighting the relentless bleed of theta decay every single day.
Exactly. The probability density function of the Black-Scholes model views that event as a statistical anomaly. Therefore, that $1 option is dead money.
It's just a corpse in the portfolio.
The delta is effectively zero. If the stock bounces $5 tomorrow, that option price will not move. It has no pulse. It is not going to recover. It's simply going to slowly amortize to zero over the next 40 days.
Now contrast that with the $18 remaining in the 430 call that our listener actually kept.
The $18 remaining in the 430 call is live money.
Because it's closer to the stock price.
Exactly. The stock is at $423. Your strike is $430. You were only $7 away from crossing back into intrinsic value.
Which is, what, like a 1.5% move?
That requires a mere 1.6% move in the underlying stock.
A 1.6% move in Broadcom is just a normal Tuesday morning if the NASDAQ opens green.
Exactly. And because the strike is so tightly clustered to the current underlying price, the contract possesses massive gamma convexity.
Meaning what, practically?
The moment the stock starts to rebound, the delta of your option accelerates rapidly. If Broadcom recovers to $435 over the next week, the value of your option doesn't just recover linearly.
It explodes.
It accelerates exponentially back into the mid-20s or 30s. You retained your sensitivity to the underlying asset.
This reminds me of how people manage their auto insurance.
Oh, how so?
What you're suggesting the listener wanted to do, rolling to the at-the-money option, is identical to calling your auto insurance broker the day before a massive hailstorm.
Okay, I like this.
You tell them, hey, downgrade my comprehensive policy to the absolute bare minimum liability coverage.
Yeah.
And the broker processes it, and they send you a refund check for the premium difference.
Right, you put that cash in your pocket.
Exactly. You reduced your absolute cash outlay, but then the hail actually hits.
And it destroys the car.
Right. The hail totals the vehicle. Sure, your bank account looks slightly better that morning because of the premium refund, but your car is absolutely destroyed, has a salvage value of 0, and you have no mechanism to repair it.
Because you bought dead money.
Exactly. If you had kept the expensive comprehensive policy, the deep in the money call, you paid significantly more premium up front, you took a harsh deductible hit, but the structural integrity of the policy remains. The insurance company still has to fix the car.
Yeah.
You can still drive to work next week.
That is a brilliant way to conceptualize the math. You didn't just lose less absolute cash, you fundamentally altered the architecture of your exposure.
You completely shifted the risk.
You transitioned a structural investment with a defined margin of safety into a pure, low-probability lottery ticket. When you buy a far out-of-the-money lottery ticket, your absolute capital at risk is very small, but your mathematical probability of total ruin approaches 100%.
Okay, but this raises a massive practical question.
Sure.
We just established that holding a 40-day expensive in-the-money option through a binary earnings event is incredibly capital intensive. And if it breaches, the absolute dollar drawdown is brutal.
It is.
So if an advanced trader simply wants to capture the massive overnight volatility swing, like if they actually want to deliberately purchase the lottery ticket, how does Wall Street actually execute that trade? Because I highly doubt institutional desks are holding 40-day options through an earnings print just to hope the margin of safety holds.
They absolutely are not doing that. If an institutional quantitative desk wants to take a directional bet on a binary catalyst, they strip out all unnecessary time value and focus entirely on maximizing gamma.
Okay, how do they do that?
They utilize the 1-DTE widespread.
1-DTE. 1 day to expiration. We're talking about zeroing in on contracts that expire within 24 to 48 hours of the earnings release?
Yes. The source materials explicitly outline this as the mathematically optimal DTE for binary event capture. For example, if Broadcom reports earnings after the market closes on Thursday, the optimal instrument is the weekly option expiring at the close on Friday.
Wait, why restrict the time frame so aggressively? If I buy an option that expires in 5 days, don't I give the stock a little breathing room to figure out its direction after the initial shock?
Because you are fundamentally misinterpreting what you are paying for in that scenario.
How so?
If you buy 5 days of time, you are paying a massive premium for 4 days of theta that you do not intend to use.
Oh, because the event is just one night.
Right. The event happens overnight. By isolating the 1-DTE contract, you are mathematically minimizing your exposure to theta decay. You are paying the absolute minimum possible premium for the time component. But more importantly, you're optimizing for the gamma peak.
Okay, let's go deeper into the gamma curve here, because this is where retail traders constantly misprice their risk.
As we discussed earlier, gamma measures the rate of acceleration of your delta. But here is the secret of the Black-Scholes model. The shape of the gamma curve changes drastically depending on how much time is left until expiration.
Okay.
If you have 40 days left, the gamma curve is wide and flat. A stock move doesn't change your delta very quickly. But at exactly 1-DTE, the gamma curve compresses into an incredibly sharp, aggressive spike centered precisely at the money.
So it's extremely hyperreactive to any movement.
It is perfectly primed to explode. If the earnings are phenomenal and the stock gaps up 8% overnight, the delta of that 1-DTE at the money option goes from 0.5 to 0.99 instantaneously at the opening bell.
Because there's no time left.
Exactly. Because there is no time left, the model knows the option is permanently in the money. This creates a massively asymmetric, nonlinear payoff. The small premium you paid multiplies 5 or 6 times over in a matter of seconds.
But hold on, if I buy a 1-DTE at the money call, I am stick directly into the path of the Ivy Crush hurricane we literally just talked about.
Yes, you are.
You just explained that at the money options get vaporized by Vega destruction the morning after earnings because the uncertainty evaporates. If I know the volatility premium is going to collapse, why would I ever buy a naked call?
You wouldn't, and that is exactly why the source strategy insists you must never trade naked options over an earnings event.
Okay, so what's the shield?
You must construct a widespread to mathematically hedge out the Vega destruction.
Explain the precise mechanics of how the short leg of a widespread actually neutralizes the IV crush.
Let's use the Broadcom setup again. The underlying is at 480. You want to bet on a massive upside surprise.
Right.
You buy the 480 at the money call for, say, $20. That $20 is almost entirely composed of inflated implied volatility.
A huge fear premium.
Yes. You know that $20 is going to get crushed tomorrow morning. So how do you defend it? You simultaneously become a seller of that exact same inflated volatility.
How do I do that?
You look way up the options chain, far out of the money, say, the 520 strike.
Wow, $40 out of the money.
Correct. Because the market makers have uniformly jacked up the implied volatility across the entire options chain to price in the earnings risk, even that ridiculous 520 strike is incredibly expensive.
Someone is actually buying that.
Oh, absolutely. Retail speculators. You might be able to sell that 520 call to a retail speculator for $6.
Okay, let's track the capital on this. I buy the 480 for $20. I immediately collect $6 by selling the 520. My net debit, which defines my absolute maximum risk on the trade, is now exactly $14.
Exactly. Now let's examine the microstructure of what happens at the opening bell the next morning when the Vega destruction hits.
The earnings drop.
The earnings drop. The uncertainty vanishes. The implied volatility parameter in the pricing model collapses from 100% to 40% across the board. The $20 you paid for the 480 call suffers a massive reduction in premium value.
Which hurts. That's the crush.
It does hurt. However, the 520 call that you sold also suffers the exact same IV crush. It collapses from $6 down to perhaps 50 cents.
Oh. And because I'm short that contract.
Because you were short that contract, because you sold it, that collapse in value is pure realized profit for your account.
Wow.
The massive Vega loss you sustain on your long leg is largely offset and subsidized by the massive Vega gain you capture as your short leg goes to zero. You have essentially constructed an IV shield.
So I am financing my directional gamble using the market maker's own inflated volatility pricing. That's incredibly elegant.
That is.
But I have a problem with the whip.
Okay, what's the problem?
Why a widespread? Why am I selling the 520?
Okay.
If I want to hedge a V crush, why don't I just sell the 485 strike? I'd collect a lot more premium because it's closer to the money,
Okay.
which would drop my net cost even further.
Because if you tighten the spread, you completely neuter the asymmetric payoff you were trying to achieve.
Walk me through that.
Let's run your math. You buy the 480 and you sell the 485. You collect massive premium, so your net cost drops to maybe $3. But look at your structural cap. Your maximum profit is strictly limited to the width of the spread, which is $5.
So I risk $3 to make a maximum of $5. My net profit is just $2.
Exactly. The math is atrocious for a binary event. If Broadcom gaps up $50 on a miraculous AI announcement, you make $2. You took on all the gap risk for a pitiful return.
But with the widespread.
By constructing a widespread 480 and 520, you give the underlying asset $40 of structural running room. If the stock gaps up to 530, your spread expands to its maximum width of $40. You paid $14 for it. You sell it to close for $40.
That is a massive return. You cap your maximum loss to a highly defined, easily managed amount of capital, maybe strictly 1% of your total portfolio. If the thesis is correct, you capture a near 300% return on investment. If the thesis is wrong, and the stock crashes to 423 like it actually did, your maximum absolute loss is strictly $14.
Yeah.
You completely eradicate the possibility of a $10,000 account drawdown.
It is the evolution from emotional gambling to quantitative execution. You dictate the exact parameters of your risk before you ever subject your capital to the market.
Okay, but as we dive deeper into the source notes provided by the listener, there is a bizarre pricing anomaly that they tracked in the real market.
I know exactly the one you're talking about.
And honestly, it feels like a massive trap designed to just drain retail liquidity. The listener observed that this exact same 1 DTE option, the one that the market maker charged $20 for the night before earnings,
Yeah.
it was trading for only $5 just 5 days prior.
Yes. That is the classic 5-day pricing illusion, and it is responsible for destroying a significant amount of retail capital.
From the outside, it looks completely manipulative. The stock price barely moved over those 5 days. It just drifted sideways. But the intrinsic price of the option quadrupled from $5 to $20, purely based on calendar proximity to the earnings date. What is actually happening in the algorithmic pricing models here?
To understand the illusion, you really must understand how market makers manage aggregate risk. You have to put yourself in the seat of the institutional desk that is legally obligated to provide liquidity and sell you these options.
Okay, assume I am managing the institutional order book.
5 days prior to the earnings release, there is no immediate fundamental catalyst on the horizon. The stock is simply drifting along with the macroeconomic currents of the broader indices.
It's just normal week.
Right. The Black-Scholes model is pricing in what statisticians call a normal Gaussian distribution. The algorithm expects the stock's daily variance to be maybe 1%. Based on that low variance environment, the model prices the option at $5. It is a mathematically fair price for a boring, low volatility week.
Okay, that makes perfect sense.
But the night before earnings, the environment undergoes a radical phase shift. The model knows that tomorrow morning, this stock is going to gap up 10% or gap down 12%.
It's guaranteed to be violent.
It is no longer functioning within a normal Gaussian distribution. The probability curve has completely flattened into a fat tail risks scenario. There is a massive probability of extreme variance.
And as the market maker, I am on the hook for that variance.
Exactly. If the market maker continues to sell you that at-the-money call for $5 and the stock violently gaps up $50 overnight, they are contractually obligated to deliver that value to you.
Wow.
They collected $5 in premium, but they have to pay out $50. If they allow their algorithmic execution to do that across 10,000 contracts, the desk faces catastrophic insolvency.
So they artificially inflate the premium to protect their own balance sheet.
They drastically hike the implied volatility parameter in the pricing model. They inflate the premium to $20. The initial $5 represented the baseline time value and normal volatility. The additional $15 is pure, unadulterated fear premium.
They are literally charging you an insurance premium against their own risk of ruin.
That's exactly what it is.
Okay, so knowing this exact sequence of events is programmed into the market maker's behavior, the obvious question you, our listener, is asking is, why don't I just front-run the algorithm?
Oh, the run-up play.
Right. Why don't I buy the call for $5 5 days early, wait for the IV to mechanically inflate the price to $20, and then just sell the contract back to the market right before the earnings report drops? I mean, I don't even have to hold through the binary event. I just manufactured a 300% profit by farming the IV expansion.
Yeah, in a theoretical vacuum, it sounds like an infinite money glitch.
It really does.
But the source materials explicitly warn against this because it fundamentally misunderstands the holistic nature of the Greeks. Retail traders focus entirely on Vega expansion and completely ignore the two invisible mechanics bleeding them out: delta slippage and theta decay.
Let's dissect delta slippage first. We're talking about directional risk during the holding period, right?
Precisely. You buy the 480 call 5 days early for $5. Your thesis is entirely predicated on Vega going up, but you are also inadvertently making a strict directional bet that the underlying stock will not decline.
Because if it goes down.
Right. Over those 5 days of waiting, what if the macroeconomic data is weak? What if a competitor issues a profit warning and the entire semiconductor sector pulls back? Your stock drifts down from 480 to 465, just a mundane 3% structural drift.
But my 480 call is now $15 out of the money.
Yes. The underlying asset has moved away from your strike. The delta goes completely against you. The mathematical probability of your option expiring with intrinsic value plummets, and the model aggressively strips value away from your premium to reflect that new reality.
And what about the theta decay? Does it accelerate?
Theta is the measurement of time decay, and the curve of theta is not linear.
Right.
An option expiring in 5 days loses its value to time exponentially faster than an option with 50 days left. Every single day you hold that contract waiting for the IV to inflate, theta is ruthlessly extracting value from that $5 premium.
So it's a structural race. You are hoping the implied volatility expands faster than the delta and theta are bleeding the contract dry.
And 90% of the time, the retail trader loses that race. Theta eats the option alive far faster than IV inflation can offset it. By the time you reach the afternoon before earnings, your $5 option hasn't magically swollen to $20.
What's it worth?
Because the stock drifted down slightly and time decayed, the option is now worth $1. You just lost 80% of your capital trying to outsmart a quantitative pricing model.
Wow. Okay, but wait. If the run-up play is a structural trap for retail liquidity, How do the institutional quantitative funds farm this IV buildup? Because we know for a fact that hedge funds actively harvest this pre-earnings volatility expansion.
They absolutely do, but they execute it using strictly delta-neutral architectures. They do not take a naked directional bet. They construct a straddle or a strangle.
Assuming you, the listener, know the basics, a straddle involves buying the at-the-money call and the at-the-money put simultaneously at the exact same strike price.
Correct. 5 days out, the institutional desk buys the 480 call and the 480 put. By executing this structure, they completely neutralize their directional risk.
Oh, because they offset each other.
Exactly. They do not care if the stock drifts up 3% or drifts down 3%. The mathematical gains on the put perfectly offset the mathematical losses on the call. Their net delta is locked at 0.
So their only exposure is pure vega. They are purely long on the volatility expansion.
Precisely. As the algorithmic VAVI inflates over those 5 trading days, both the call and the put become significantly more expensive due to the institutional fear premium being injected into the pricing model.
And then they just dump it.
Then, perhaps 15 minutes before the closing bell on the day of earnings, the desk liquidates the entire straddle, harvests the pure IV inflation, and flattens their book without taking a single ounce of overnight binary risk.
That is a phenomenally clean strategy. Why can't our advanced retail listeners simply execute that exact straddle structure?
Because of the massive structural friction involved in maintaining delta neutrality over a multi-day period. First, there's the capital intensity. Buying a straddle is inherently twice as expensive as buying a naked option. You are tying up significant margin.
Right.
But the real barrier is the execution mechanics.
The continuous hedging.
Exactly. As the underlying stock price fluctuates over those 5 days, the delta of the call and the delta of the put do not change at the exact same rate. Your position slowly becomes unbalanced and drifts away from delta 0.
So how do the institutions handle that?
Institutional desks utilize high-frequency algorithmic execution to constantly buy and sell fractional shares of the underlying stock in the dark pools to perfectly balance their net delta back to 0 every few seconds.
They are actively managing the hedge in real time.
Real time, milliseconds. A retail trader simply does not have the API access, the lowered margin requirements, or the millisecond execution speed to replicate continuous delta hedging. If you attempt to manually rebalance your straddle every few hours, the bid-ask spreads and the inherent slippage will entirely consume your vega profits. The strategy only works at institutional scale.
Okay, so farming the run-up is essentially off the table for retail. We must accept the 1 DTE widespread for the binary event. But this leads us to another fascinating mathematical paradox documented in the sources.
The time paradox, right.
Yes, this is something you actively tracked in the order book. We just established that the 1 DTE 480 540 widespread costs exactly $15.
Yep.
But if you look further down the options chain, the exact same strike prices, a 480 540 spread, but expiring in 45 days, costs $20.
Ah, the time pricing paradox. This is where options math becomes deeply counterintuitive for traders transitioning from equities.
It violates basic common sense. I mean, you're getting 40 extra days of life. You are getting almost a month and a half of extra time for your underlying thesis to play out, and the market is only charging you a $5 premium for it.
It looks like a massive bargain.
Why on earth would any rational trader risk $15 on an overnight 1 DTE binary gamble when you can secure 45 days of structural safety for just $5 more? The math screams to buy the 45-day spread.
The math only screams that if you fail to deconstruct the individual legs of the spread, you are operating under the illusion that you are purchasing time at a massive discount.
But I'm not.
You aren't. Let's break down the precise algorithmic pricing of that 45-day architecture to reveal the trap.
Okay, deconstruct the legs for us.
In the 45-day spread, your long leg is the 480 call. Because it possesses 45 days of implied volatility and time value, the model prices it very highly. It costs $35.
Right. It is massively more expensive than the 1 DTE long leg, which makes sense because of the time.
But now look at the short leg that you are utilizing to finance the trade. You are selling the 540 call. Because that specific 540 call also possesses 45 days of life, it is viewed as a highly valuable asset by the quantitative models buying it from you. You are able to sell it for $15.
I see the math. The $35 cost for the long leg minus the $15 of premium I collected from the short leg equals a net debit of $20.
Exactly. Now, Critically analyze what you actually executed there. Did you get a discount on time? No. You subsidized the massive cost of your long leg by selling away a highly valuable long-duration asset.
So mechanically, what does this mean for the behavior of my trade?
It means you have structurally mortgaged your future upside velocity to subsidize your entry cost today.
Let's run an ROI showdown to make this concrete.
Okay, let's do it.
Let's assume the absolute maximum upside scenario occurs. Broadcom reports a historic quarter, announces a massive stock buyback, and the stock violently gaps up to $550 the morning after earnings.
If you are holding the 1 DTE spread, your trade resolves immediately. Because there is no time left on the clock, the options mathematically converge to their intrinsic value.
Instant max profit.
Right. The spread achieves its absolute maximum width of $60 instantly at the open. You paid $15 to enter the trade. Your net profit is $45. That is a clean, hyper-efficient 300% return on investment realized in 12 hours.
Massive capital efficiency. Now, what happens to the trader who bought the 45 DTE spread for $20? The stock is at $550. They must be printing money.
They are realizing a profit, but their architecture is fundamentally constrained. The 45 DTE spread does not achieve maximum value on day one.
Why not?
Because that 540 short leg you sold still possesses 44 days of time value embedded in its price. It refuses to go to zero. The institution that bought it from you is still holding it, fully expecting the stock to grind even higher over the next month.
So the persistent value of the short leg acts as a mathematical anchor, dragging down the net value of my total spread.
Exactly. Even though the stock blew past your strikes, you might only be able to liquidate the total spread for a 125% ROI instead of 300%. You sacrifice the explosive nonlinear upside of the binary event.
And what if the thesis is completely wrong? What if the stock crashes down to 423, just like it actually did?
Well, the 1 DTE spread instantly expires worthless. You realize a maximum defined absolute loss of $15.
And the 45 DTE spread?
The long leg suffers catastrophic delta and vega collapse. The short leg collapses as well, providing some subsidy, but the net mark-to-market value of the total spread drops precipitously. If you attempt to liquidate on day one, you will likely realize roughly $15 in absolute cash loss as well.
So the absolute downside capital risk is virtually identical, but the upside velocity is severely crippled in the longer duration architecture.
Which leads to a definitive quantitative rule. Wide spreads are strictly designed as mathematical tools for capturing short-term explosive gamma around binary events. They are fundamentally structurally deficient for long-term holding because the short leg continually suppresses your delta expansion.
This is a phenomenal paradigm shift. We've spent the first half of this deep dive rigorously deconstructing the illusions of absolute cash, the traps of pre-earnings FIV expansion, and the mechanics of why certain spreads fail.
That's a lot of groundwork.
But now, it is time to transition from forensic analysis to proactive architecture. Taking all these harsh mechanical lessons, you actually synthesized a brilliant two-stage quantitative strategy. We are moving from analyzing a failure to building a Wall Street-level execution system.
The VP8 evolution. Volume-weighted post-earnings announcement drift. It is a highly sophisticated piece of financial engineering that perfectly separates the binary risk from the structural trend.
Let's rigorously define the two stages. Stage one is the earnings night execution.
Right. We have thoroughly established this protocol. If you determine you absolutely must have capital deployed during the overnight binary event, you strictly utilize the 1 DTE wide spread.
Keep it tight and wide.
You define your absolute maximum risk to a negligible percentage of your portfolio, say 1%. You are mathematically acknowledging that you are participating in a fat tail variance event, and you are using the optimal instrument to capture the gamma asymmetry while hedging the Vega crush.
You compartmentalize the gamble. But stage two is where the institutional capital is actually generated, the PED institutional ride. Let's dive deep into the mechanics of PED because this isn't just a chart pattern, it's a structural market anomaly.
Post-earnings announcement drift is arguably one of the most thoroughly documented, academically verified inefficiencies in modern equity markets.
Okay, break it down for us.
To understand why it exists, you have to understand institutional order flow. When a massive mega-cap company delivers a true beat and raise, meaning they significantly exceed consensus revenue and earnings estimates, and they aggressively raise their forward guidance for subsequent quarters, the fundamental valuation of the company must be completely recalculated.
The analysts have to literally rebuild their discounted cash flow models overnight.
Exactly. And when those new models print, massive institutional pools of capital mutual funds, sovereign wealth funds, pension architectures managing hundreds of billions of dollars must reweight their portfolios to account for the new valuation.
But they can't just log into a brokerage and click buy at market for 5 million shares.
Oh, absolutely not. If they attempted to execute a 5 million share block order in a single session, they would consume all available liquidity in the order book. The bid-ask spread would violently gap up against them, and they would ruin their own average entry price. They would cause a localized flash spike.
So how do they actually deploy that capital without moving the market?
They utilize algorithmic execution strategies, specifically VWAP volume weighted average price algorithm.
VWAP, right.
These algorithms are designed to slice that massive 5 million share order into thousands of tiny microtransactions, executing them steadily over the course of days, weeks, or even months, blending their volume into the natural daily liquidity of the stock.
And it is that relentless programmatic underlying bid that creates the drift.
Precisely. The continuous algorithmic buying pressure creates a structural upward drift in the stock price that persists for 30 to 60 days following the earnings catalyst. That is the mechanical engine of PEED.
So how does this new VP strategy optimally capture this anomaly?
The absolute genius of the strategy relies on patience and timing. You dictate that you do not deploy capital on day one. You do not chase the initial gap up. You wait 2 to 3 full trading sessions post-earnings.
Why wait? Why miss the first 3 days of the drift?
Because you are waiting for the options pricing model to completely normalize. You wait for the IV crush to fully extract every single ounce of fear premium out of the derivatives market.
Let the dust settle.
Exactly. You allow the volatility tourists to wash out of the order book. Once the implied volatility resets to its baseline Gaussian distribution, the options become mathematically cheap and clean.
And what specific instrument are we deploying once the pricing is clean?
You deploy clean directional capital. You purchase 30 to 45 DTE options. You look slightly out of the money, targeting a delta parameter around 0.35 to 0.40.
This is strategically brilliant. You're essentially constructing a system where you allow retail speculators to fund the massive implied volatility premium on day one, watch them get crushed by the math, and then you step in on day 3 to ride the structural algorithmic wave with heavily discounted high-duration options.
It is the conceptual difference between playing a slot machine and investing in the company that manufactures the slot machines. You are actively avoiding the volatility premium trap and instead aligning your capital strictly with the largest, most persistent institutional order flows in the market.
Okay, the theory is ironclad. Let's look at the technical execution of how this applies in a live market environment. The source materials provide us with a perfect, real-time case study to stress test this VP8 strategy. You were scanning the market for viable setups and identified Dell.
Dell presents a highly complex, absolutely fascinating structural setup for this analysis.
Dell reported a monster earnings quarter. The stock ripped to an all-time high of $465. But then, during the subsequent trading session, the stock violently retraced downward. However, by the end of the day, the chart printed what technical analysts refer to as a long lower shadow, or a pin bar.
Yes, but before we even look at the microstructure of the order book that created that shadow, the VP8 system requires absolute verification of the fundamental engine. PEED does not exist without a true beat and raise.
And Dell absolutely met the criteria. They printed $43.84 billion in revenue. Their earnings per share came in at $4.86 against the consensus expectation of only $2.93.
A massive beat.
And the fundamental kicker, they announced a $60 billion backlog strictly for AI server infrastructure. That is a textbook A-plus fundamental catalyst. The engine for the institutional drift is fully fueled.
The fundamental engine is confirmed. Now, we must transition to analyzing the microstructure of the market, the actual order flow that printed that candlestick, the long lower shadow.
Let's assume you know what a pin bar looks like, a small body at the top with a massive wick extending downward. I want to know what is actually happening mathematically in the order book to form that shape. Is a long lower shadow always a definitive signal that institutional algorithms are accumulating shares on the dip?
Absolutely not. Context and order book dynamics are everything. To validate this specific candlestick as a true institutional accumulation signal rather than a liquidity trap, you must process it through 4 rigorous quantitative filters.
Let's run the filters. Filter number 1, location context.
A long lower shadow is a high probability accumulation signal when it prints at the bottom of a prolonged, multi-week downtrend.
Okay, why at the bottom?
In that context, it signifies that algorithmic stop-loss hunting has occurred. High-frequency algorithms push the price down to trigger a cascade of retail stop-losses located below key support levels. Once those retail orders flood the market with sell liquidity, the institutions instantly absorb all of those shares, instantly reversing the price upward and leaving the long shadow behind.
They engineer the dip to generate the liquidity they need to buy.
Precisely. However, if that exact same candlestick prints at the absolute top of a parabolic multi-month run, which is exactly where Dell was sitting at its all-time high, it is an incredibly dangerous signal.
What does it mean there?
In this specific location, technical analysts call it a hanging man. It frequently indicates institutional distribution. The smart money is utilizing the immense retail FOMO generated by the earnings beat to quietly offload their massive positions into the bid, satisfying the retail demand while subtly exiting the market before a larger structural correction.
So the location of the print completely inverts the mechanical meaning of the volume.
Yeah.
Filter number 2, volume analysis.
The shadow must be corroborated by extreme relative trading volume. If the pin bar forms on low or average volume, it is merely intraday noise. It is just low liquidity fluctuation in the spread. But massive, highly elevated volume proves that significant capital changed hands at those lower price levels. It confirms institutional participation.
Filter number 3, the geometry of the rejection.
The shadow itself, the lower wick, must be at least 2 to 3 times the vertical length of the real body of the candle. This specific geometry indicates a violent, aggressive rejection of the lower pricing tier by the order book.
And finally, filter number 4, which is where most traders fail, the confirmation protocol.
This is the absolute most critical step, and the one that retail traders consistently ignore because they are driven by the fear of missing out. You must wait for the subsequent daily trading session to confirm that the directional momentum is actually sustained.
What are you looking for exactly?
You must require the start price to definitively break above the high of the pin bar candle. That break confirms that the buyers actually won the liquidity battle and have assumed control of the trend.
Which brings us directly to the massive hidden danger in this specific deal kill case study, the insider threat.
Yes. The source materials highlighted a critical piece of SEC filing data. Silver Lake, a massive private equity entity and a major corporate insider, executed massive block selling of their shares precisely at that top.
The insiders are actively distributing shares into the retail earnings hype.
Exactly. And if you look at the pre-market order flow the following morning, the stock is still bleeding downward. The selling pressure has not abated.
So, applying the strict logic of the VP strategy, what is the exact execution directive for this Dell setup?
The directive is mathematically absolute: do not attempt to catch a falling knife. The fundamental engine is superb, the shadow geometry is present, but the location is dangerous, the follow-through confirmation has definitively failed, and massive institutional insiders are actively distributing shares. You must hold your capital.
You wait. But what specific mechanical signal are you waiting for?
You demand that the market proves its structural integrity. You wait for the intraday price action to definitively break above the opening print or the previous day's closing print on a 1-hour timeframe chart. Only then, once the broader institutional accumulation has proven mathematically capable of absorbing and overwhelming the Silver Lake insider distribution, do you execute stage 2. Only then do you deploy capital into those 40-day out-of-the-money calls. You force the market to validate your hypothesis before you risk a single dollar of your portfolio.
That is the definition of cold, calculated, quantitative discipline. Okay, we need to return full circle to where this entire deep dive began. We need to address the bleeding Broadcom trade. You are still holding this underwater position. And in an attempt to stymie the absolute capital bleed, you executed a highly advanced secondary maneuver.
Ah, the art of the defensive role.
Right. You look at your architecture, you bought back the dead $550 short call, which had decayed to practically zero value anyway, and you simultaneously sold a brand new $480 short call against your core long position. Is this a mathematically sound rescue architecture, or is this just the panic flailing of a trader refusing to accept a loss?
It is a deeply fascinating, structurally complex tactical adjustment. To understand if it's viable, we have to meticulously analyze the Greeks and the absolute math of what quantitative traders call rolling down the short leg.
Let's run the exact math on the adjustment.
By executing the sale of the new 480 call, you injected a fresh premium of approximately $7.50 into the position. That is $750 of immediate cash credited directly into the account.
Which psychologically provides an immediate dopamine hit when your primary position is bleeding out.
It does mitigate the psychological stress, sure. But more importantly, it mathematically alters the absolute risk profile of the entire portfolio. Because you collected that premium, you instantaneously reduce the maximum defined structural loss of the trade.
By how much?
If your absolute worst-case scenario max loss was previously $10,000, capturing that $750 permanently reduces the max loss to $9,250.
So it operates as a tactical liquidation. You are systematically forcing a reduction in your total portfolio risk exposure without entirely abandoning the underlying directional thesis.
Precisely. It is a highly efficient mechanism for playing structural defense. However, the options market is a closed ecosystem. There is no free capital. To extract that $750, you had to make a severe structural sacrifice to your architecture.
We upside cap.
Exactly. Your absolute maximum profit potential is now permanently restricted to the $480 price level. Because you sold the contract obligating you to deliver shares at $480, you have structurally amputated any profit potential above that line.
So even if Broadcom announces a revolutionary new AI server architecture tomorrow and the stock violently gaps up to $600,
your architecture captures absolutely zero value beyond $480.
you have completely neutralized the exact nonlinear gamma explosion that you originally bought the in-the-money calls to capture.
You have. And this structural limitation introduces the absolute most dangerous mechanical risk of this specific defensive maneuver, the whipsaw risk or the gamma squeeze death trap.
Break down the mechanics of the death trap. How does a defensive roll freeze an account?
Let's simulate the scenario. The macroeconomic environment shifts. The Federal Reserve signals a rate cut, and the entire semiconductor sector violently rallies. Broadcom executes a massive V-shaped recovery, ripping past 460, and accelerates aggressively back toward your $480 strike.
At first glance, that sounds fantastic. My underlying 430 long calls are rapidly gaining intrinsic value. My account balance is recovering.
But you are failing to calculate the real-time Greek exposure of the 480 short call you just sold. As the underlying stock rapidly approaches 480, and particularly because the time to expiration is shrinking every day, the gamma parameter on that specific short call begins to mathematically explode. The contract becomes hypersensitized to underlying price movements.
So what actually happens to my net portfolio delta?
The short call begins generating negative delta at a severely accelerated rate. It will rapidly approach a 1-to-1 inverse ratio against the stock price. For every single dollar of value your 430 long call generates on the recovery, your 480 short call mathematically subtracts a dollar of value.
The negative delta of the short leg perfectly neutralizes the positive delta of the long leg.
Exactly. It completely freezes the net mark-to-market value of your architecture. It physically prevents your underlying long calls from recovering their previously lost capital. You are structurally trapped in a neutralized position while the stock soars past you.
Okay, so fully grasping the mechanics of this, the absolute profit ceiling and the severe mathematical risk of a gamma squeeze freezing the account, what is the final objective directive for the listener currently managing this Broadcom trade?
The quantitative validation of this defensive role relies entirely on the accuracy of your forward-looking assumption. If your core thesis is that Broadcom, having fundamentally exhausted its earnings catalyst, lacks the macro volume to re-challenge the $480 level within the next 30 days, then the defensive architecture is mathematically validated.
And what is the execution protocol in that scenario?
The directive is do absolutely nothing. Sit on your hands, allow the structural passage of time to work in your favor, and slowly harvest the theta decay wages as that 480 short call slowly amortizes down to zero.
You just bleed the time value out of the contract.
Exactly. However, and this is the paramount condition of managing dynamic risk, if the market environment shifts and the stock unexpectedly catches a massive bid and rallies into the 455 or 460 range, the probability matrix has fundamentally changed.
The structural ceiling is closing in too fast.
Yes. At that precise moment, you must instantly execute a buy-to-close order on the 480 short call. You must willingly pay the mathematical penalty to close that contract, immediately remove the structural handcuffs from your portfolio, and allow your core long position to re-engage its positive delta and fly unencumbered.
Wow.
You cannot implement complex structural constraints if you lack the discipline to dynamically dismantle them when the probability curve shifts.
Okay, let's pull all these complex threads together because the analytical journey we have traversed today has been staggering. We initiated this deep dive with you trapped in a purely emotional, reactive state following a violent, multi-standard deviation earnings drawdown.
We systematically replaced that emotional reaction with cold, quantitative deconstruction. We isolated the precise behavior of delta, gamma, theta, and vega across distinct probability curves during a stress event.
We mathematically dismantled the psychological illusion of absolute cash savings, proving why retaining a structural margin of safety is infinitely more valuable than pocketing a premium refund. We exposed the mechanical traps of the 5-day pre-earnings 5E expansion and demonstrated precisely why institutional algorithmic desks utilize delta-neutral structures to farm volatility while retail speculators simply bleed out to theta.
And finally, we transcended basic forensic analysis and constructed a fully robust institutional-grade execution architecture, the VPE system. We integrated 1 DTE-wide spreads for strictly defined binary risk containment and coupled it with 30 to 45 DTE instruments to cleanly capture the structural algorithmic drift, all governed by rigorous order book validation protocols.
It represents a complete fundamental paradigm shift. We've transitioned the methodology from hoping for a lucky gap up to engineering a mathematically sound quantitative system. And as we conclude this extensive analysis, I want to leave you with a final forward-looking macro thought.
Okay, what's the thought?
We've spent an hour detailing how market makers algorithmically price binary events. But consider the current evolution of market structure. Over the past 24 months, we have witnessed an unprecedented explosion in retail and institutional volume, executing strictly 0 DTE and 1 DTE options contracts.
The volume profile has completely inverted. Yeah.
Exactly. When millions of contracts were expiring on the exact same day as the earnings catalyst, it completely alters the fundamental plumbing of the options market. The market makers are forced to aggressively hedge those massive short-term positions in real time, buying and selling the underlying stock furiously into the close. The provocative question is this massive hyper-concentration of 1 DTE gamma actually beginning to dictate the underlying stock price itself?
That's a scary thought.
Are we entering an era where the derivatives market has become so massive, so highly leveraged, and so algorithmically interlinked that the tail of option hedging is completely wagging the dog of the fundamental equity market?
It suggests a future where fundamental analysis of a company's earnings might become secondary to analyzing the structural positioning of the dealer gamma exposure.
A future where understanding the math is no longer just an edge. It is the absolute prerequisite for survival. The options market is ultimately an insurance market. Every time you buy an option, you are paying someone else to take on your risk. The ultimate evolution of a trader isn't predicting exactly where a stock will go, it's mastering the exact price you are willing to pay for your peace of mind. Thank you for joining us on this deep dive into the architecture of risk. Keep ruthlessly questioning the mechanics operating beneath the market's surface. We'll see you next time.